All right. Hello, 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 everybody that has joined. I'm giving everybody one more minute. All right. Hello and good afternoon. Welcome to the State of Tech in Africa for 2020-15. For those who don't know me, I am Nafi Abrams. I am the Operations and Program Manager at AfricArena, and we are so thrilled to have all of you join us here today. We've got a jam-packed program and a very little time, and we want to make sure that we deep dive into everything that you need to know that's happening to the tech space. For those who don't know, this is the sixth edition of the State of Tech report that AfricArena has launched. The report technically provides an in-depth analysis of the current landscape of technology in Africa, and it focuses on key trends, innovation, and challenges that the tech ecosystem is facing. And I'm so excited for you guys to hear a bit more about it. To kickstart this amazing event, I'm going to hand over to my partner in crime and my colleague, Dan Mabelas. Dan's going to give us a high level overview of the work Africa Arena does and the impact we've had in the year 2024. Over to you, Dan, and thank you so much for joining us.
Thank you so much, Nafisa, and thank you everyone again for joining. It's really an exciting day for us as we're launching our sixth edition of this report. But first and foremost, we would like to, again, welcome you and explain to you a bit more about what AfricArena is, for those of you who don't know. So basically, AfricArena, outside, we are seen as that event company that just goes across Africa, that organize these seminars and those conferences with panels, etc. But we are more than that. So we are a platform that helps startups connect with investors. And the way we do that through a tour, series of events that we organize every year in Africa. And from there, we also have different missions that helps to accelerate the ecosystem. I think if you see on our brand, we are an ecosystem accelerator. So if you look at a bit of our impact since 2017, you can look at a bit about our numbers, the number of startups that we have had annually in terms of application, the startups that have pitched through AfricArena since 2017. But what we are really proud of is that through that initiative, we have been able to help startups directly or indirectly through the platform raise about 850 million plus. So that's a number that will grow again this year, grow again next year. We are here to try and help as much as we can bring in foreign investment in Africa. So a bit about our ecosystem DNA, actually what we do under the umbrella of AfricArena. There's a lot of things. I'm not going to have the time to go through everything, but I'm going to speak specifically on three initiatives that we are running: Africa Rise, Digital Collective Africa, and AfricArena Wired, which is our all-in-one app. So if I can just dive in a bit. So Africa Rise, on one side, under AfricArena, is our acceleration program that helps startups throughout the year. We have startups with an acceleration investment readiness program. We organize coaching, investment deal support, etc., one-on-one intros. And through that, our startups actually come and participate and pitch in our events. Now, if you look at, and that actually runs throughout the year. Now, a look at what this year is. Maybe you have heard it in the ecosystem. So Digital Collective Africa is that community that assemble mainly, even though we also have accelerators and founders in our community, we bring investors together through different initiatives. One of them is called, perhaps you have seen it, VC Conference, whereby we bring investors together to discuss between 1-2 days about how to accelerate and improve the way investments are done in Africa. So you can have a look at the website, you can check, you can see there's also a lot of, I would say, free items that you can download as a founder, and many work groups that we work with that helps founders to get to know more about how to raise funding and what investors are looking for. So a look a bit about Application Wired. So this is really our all-in-one platform where you will find out everything across AfricArena. So there you'll be able to replay our videos, you'll be able to see our different content, check our blogs, And in that, actually, one thing that is very interesting that we are launching actively this year is that we have a platform that is called the Investor Portal, whereby all our alumni startups, you can have access to their general data, such as the sectors. You can rewatch their videos, their pitch. You can also have a look at the pitch deck that they are able to share publicly. So it's something very very insightful that also we offer to the ecosystem. So a bit about the look of what we did in 2024 before handing over back to Nafisa for the next part of our webinar. So last year, it was quite a successful circuit. So we were in about 5 ecosystems. So we went in Nairobi, Tunis, Morocco. We just had outside event, the VCN conference. I went to in Ivory Coast, and then, as you perhaps know, at the end of each tour that we organize each year, we organize what we call a grand summit that assemble all the winners of the tour. And then we also have the privilege to go outside of Africa to just attract more funds into the continent. So we went in London, Paris, alongside Vivatech, and also Seoul in South Korea. So this year we want actually to make it bigger. We're going to speak a bit more about what's going to come next, but also check our social media and website in the coming few days. We start announcing step by step our circuit. So a bit about our metrics of last year. So as I mentioned, 8 cities, 120 startups pitching in our events, 30% female-led founders. That's something that we are really proud of. 300 plus speakers, 200 plus online viewers and attendees, 300 plus investors that joined the event. So really, really a year 2024 that we had in terms of those metrics. And if you look at the Grand Summit alone, one particular thing about this Grand Summit, it was the most impactful that we have to date, just because of the representation of the African countries in the event, the number of attendees, the number of in-person investors that almost matched the entire tour, the number of participating startups. So we really can say confidently that we are this platform that helps the African ecosystem connect and move forward together. So a bit about our sponsors and partners. Thank you so much once again. A shout out to AWS Startups, Jared Size, TIA Technology Innovation Agency. Without you, all this work wouldn't have been possible. So without further ado, I will hand over back to Nafisa so she can introduce the next session. But this QR code, you can have access to everything that I spoke about, the website, the product, the links of the app, and you can have for yourself a read and then check what's going on out there in AfricArena. Okay, so over to you, Nafisa. You can introduce the next part.
Thank you so much for that amazing overview of AfricArena, Dan, and the impactful work that we are doing currently. Before I hand over to the next person, because I want to make sure that I do all the hard work he does in the ecosystem justice, I just want to give everybody a bit of a breakdown on some house rules for the webinar. So please make sure that you're ready by now, have your drink in your hand, because it's about to get very interesting. Please use the chat pane to tell us where you're from, where you're dialing in from. Please ask as much questions as you want to know from the amazing tech leaders that we're about to see. And as AfricArena is known for always having fun, please do. This is a session to learn more about what we do and also ask everything that you want to know. And most importantly, make sure that it's a valuable session. So I'm very excited for the next part of this webinar. We are going to deep dive a bit into the numbers. And I am so honored and always so privileged to be able to introduce someone that's very key to the AfricArena team, Abdurrahman Shawi. He's a visionary leader at the forefront of the African tech evolution with a wealth of experience in innovation, venture capitalism, investments, and honestly, just his work that he's done to help shape the African ecosystem has been impactful. So over to you, Abdurrahman, and thank you so much for being here with us today. So we are so honored and privileged, and just thank you so much for always being such a support structure for AfricArena. We love you so much, and you know that. So over to you. Please tell us what's happening with us and what do we need to know about what's happening in the ecosystem.
Thank you, Nafi. I love you guys too a lot. Always a pleasure to be here. Hi, everyone. Thank you for being here as well. So we have about 5 minutes together, and there is a few points that I want to focus on also because later on we will have a full panel with very, very interesting panelists, and they have a lot to say. So I think you will have everything covered. So on my part, I will focus on 2 or 3 messages. We're gonna have a look at the main discrepancies between the reports that always come out at this time of the year. Today we only have not Briter, but Africa, the Big Deal and Partech reports that have come out. So we're going to have a look at that and talk more broadly about the key differences about in terms of methodology in these reports, and then have a look, let's say, different perspective at the numbers. So let's jump in. The first thing to notice when you look at the data that is always reported about funding in Africa is that you have like key differences, and these differences come from 2 main reasons. The first one will always remain. It's the number of the proportion of undisclosed deals. We estimate that it's about 40% of deals and about 15% of total funding that is undisclosed. That will remain the case. It has been approximately the same proportions since we started recording these statistics. And what you need to bear in mind is that the report providers will have a different approach with regards to these undisclosed deals. Some will take into account, let's say, the whispers and what they know, what they've been told. Other will only focus on what they can verify for sure. And that explains a little bit of the differences. So for instance, this year, Partech announced $3.2 billion of funds raised by startups, while Africa, the Big Deal, announced only 2.2. That probably comes a little bit from there. Also, you have a lot of deals that goes under the radar because they are just too small. Partech only tracks equity or debt rounds that are 200K or above. Africa, the Big Deal, will focus on 100K and above. That means that a lot of deals, especially in younger and smaller ecosystems, will go undisclosed, which might give you an even more reduced downsized perception of the activity in these younger ecosystems. In countries as well, like for example, South Africa, you have like a lot of business angels, and the proportion of business angel funding is higher than elsewhere in the continent, and that usually is not recorded. Also, you have a big misalignment, which is actually the reflection of our own misalignment on the very definitions that are the foundation of our work, and that comes back that comes down to one single question: it's what to include and what not to include, and it's not that simple. So, for instance, what do we consider as a tech startup? What is more SME? Is an agriculture business a startup? Should it be taken into account in these reports? Is the startup African or not? So we don't have clear definitions about all these questions, and it goes as far as what to consider a deal. So, for example, Brighter Bridges would include M&A, mergers and acquisitions, in their reports, while others won't. And both positions are very understandable. And actually what that means is mostly the reflection of the fact that we don't have still, and year after year we keep talking about that, but we still don't have a common data index or a common definition glossary that will help us build a continental data hub for our startups. That's for the first point about the data discrepancies, and I hope you understand it better. I'll go very, very quickly on this one because it's not that interesting to just comment the numbers. Basically what both reports tell us is that the decline in funding continues since 2022. It's slowing, but it's kind of stabilizing in H2. It also tells us that the Big Four is always the Big Four, with like 85% of funding that has been attracted in these 4 countries. And it also tells us that our investments is still very much hype influenced, if I could say. Basically, people invest where other people invest, and it's fintech, climate tech, AI that have attracted the most funding by far. So that will be a very simplistic perspective and read over these reports. But what's more interesting to me, and that's what I want to focus on in the last minutes that we have together, if we can move to the next slide, is that actually when you look at the numbers since 2019, for example, you understand the heavy influence on these statistics of a few founders and of a few investors. And that actually could give you a complete different understanding of the decline, the growth, and everything that happened in our funding statistics since we started recording them. So basically, let's focus first on the entrepreneurs. So last year you have about 10 startups that raised 25%, so 1/4 of all funding. And this proportion, like 10 startups for like 25%, is almost the same if we consider all the numbers since we started recording them in 2019. This is huge. And that means that the overall volume is still too low for us to only rely on these statistics to understand the dynamism of one ecosystem. If you take Benin, for example, that raised 50 million last year and made its first appearance in the top 10, it will be also the case for Senegal or Tunisia or even Algeria a few years before. Wherever one of these super founders with an extraordinary curriculum and a super deep network with international VCs, especially in the US, manages to raise one mega round, it has a mega impact, of course, on the funding statistic in these countries, but also in overall in our continent. It's also interesting to note that from the 9 unicorns that we have in Africa to date, 6 have obtained their status in between 2021 and 2022. And the question it lets us wonder with is whether this was made possible because of the heavy cash inflows that were going to our continent, or if the funding peak that we had in 2021 and 2022 was not due to the simultaneous appearance of these super founders. I think it's very complicated to answer that question, but we might have the answer next year in 2025 with a lot of startups that have raised one mega round during that time or last year, and that are expected to raise one other mega round anytime soon. And this simultaneous, like this conjuncture, the fact that it comes in grade or in kind of promotions, impacts even more the funding statistics. So that's one thing. If you follow the numbers very carefully, maybe next year you will be positively surprised. And the same actually lecture could be made with the investors. And what's interesting with the investors is to understand the cyclical, I don't know how to pronounce it, sorry, cyclical nature of VCs, the fact that it comes in cycles, and that many funds that were among the most active funds in 21, 22, like Launch Africa, like Lofty Inc., Flat Six Labs, etc., have considerably reduced their activity in the last 2 years. That's not because they stopped believing in the continent. It's because of these cycles and because of a bad conjuncture with international macroeconomic conditions like considerably reducing their ability to raise their next funds, but they are long awaited, they are expected, and they will come back, probably reach their former activity levels starting from next year or the one after that, and that's very reassuring for our ecosystems, because the impact of these funds in specific countries or more broadly in Africa has been huge. For example, in Tunisia only, Flat 6 Labs accounted for like more than 50% of deals in 2021 and 2022, which could explain why Tunisia has had a kind of disappointing performance last year if we only track the numbers. On a last note, and because I've been long already, sorry, Nafi and Dan, just a few signals to remain optimistic for next year, although I think that with this last lecture of the number, we have different reasons to be optimistic. But I believe that one trend is confirming as the one exit path for founders in Africa, its mergers and acquisitions. So this has been confirmed with a lot of successful announcement, which also demonstrates a growing maturity from African founders, because this is always motivated by different strategic rationale that all make sense. I think it's very positive. And very lastly, we can note a lot of Pan-African initiatives that are growing, like the Timbuktu Fund of Fund, Prosper Africa, that recently announced a super initiatives to unlock credit for early stage founders. So we have a lot of very positive weak signals that are yet to be confirmed, but that are showing that we are going in the right path, that we are growing in maturity as a whole, as an ecosystem, and that our understanding of the right problems is getting sharper and sharper. And for that, I'm very reassured for next year and very well motivated. So thank you all, and I'm sure you will have a lot more insights coming to you.
Thank you so much, Abdul. Those were very insightful. Dan, do you need have anything you want to add before we jump to our incredible panel?
Yeah, I actually have things to add, but I'm going to be very quick. Very quick, because Abdul already covered like actually a lot of important point. I'm just going to underline with nice graphs on my side. And I'm not going to cut, the suspense, because we just want to run into the main panel, because I know, yeah, the topic will be hot to discuss with. So just an overview on my side for the rest of the report. So first of all, before even jumping there, Abdurrahman has been really a key actor into the report itself, with the first section whereby you can have everything regarding 2024 when it comes to numbers. But when you're going to look at the rest of the report, we cover, I would say, main sections. I'm just going to cover very briefly. So we look at the big four a bit in depth. And like you say, there's nothing much to say again. It's again the big four for the past 5 years since the data started to be tracked. Nothing really new to say, but I would like to say, especially on the AfricArena side, we have seen really Kenya so active into the funding scene, whether the data between Partech and Africa the Big Deal have been different, etc. We just wanted to put a shout out to the Kenyan ecosystem, specifically also Nigeria, to coming a bit up as well with the unicorns. But really Kenya has been pushing, especially on the startup side, to become really, from what we have seen, regardless of the reports, the top destination when it comes to funding. So in the report, you'll find out a bit more about what is actually Kenya doing to attract so much. And that can be actually a pattern that other ecosystem can inspire themselves from. So you can have a bit more and check a bit more about those insights inside the report. I'm not going to go in depth into it. And then we just wanted to also acknowledge our rising stars when it comes to two ecosystems specifically, where actually we went last year, Morocco, Ivory Coast, year-on-year increase, both really putting more and more value in the ecosystem. Morocco being really the platform of GITEX that we know is one of the major tech events in the world. And also look at Ivory Coast with the great work that M Studio is doing as a venture studio, as well as other partners there on the ground. It's really inspiring also what the other ecosystem are doing. We also have other ecosystems that we could speak with, Zambia, Togo, and so on, you name them. But all we wanted to say is keep up the good work. We need to rise as an ecosystem. So a bit about the top sectors again, and that has been actually increasing compared to last year. Fintech again on top. I know that it's going to be a hot topic in today's discussion. We had a bit of rehearsal yesterday, and we could already see that we need to point out those aspects. Coming behind, energy again that dropped by 8% from last year. Logistics, agriculture, health tech, deep tech. In education again coming to the prospect. So not much changes since last year, just the volume of funding that has decreased. So if you look at also on Partech side, it's kind of looking the same when it comes to specifically equity, with fintech leading, clean tech, which can be under the umbrella of climate, and so on. So a bit about diversity, we can clearly see that both Africa the Big Deal, Partech, regardless of where you take the data, that we are still so low when it comes to investing, especially in female-led startups. And this is a topic where we wanted to dive a bit more into the report. So you're going to find a bit about what the fund's actually doing, how can we increase this number, how can we include more diversity around the scenes of the ecosystem. And then one of the work that Digital Collective Africa, did last year is we launched what we call a diversity pledge that we shared and that we amplified to the funds in Africa to tell them, hey, would you pledge into bringing funding into female-led startups, and by how much? So we sent commitments for 2024. We started to get the results, and what we have seen is that some decreases from some of the funds, but also increases. Shout out to Startup Bootcamp, which is doing excellent work. E-Squared, Grindstone as well. We have seen really those funds trying to push a bit more the Agenda Catalyst Fund, Digital Africa. So we would like to push again to this initiative to keep up the good work. And then, a bit about also our predictions that you can also see on the report, just to close out the report breakdown. So for this year again, we are trying to be optimistic at AfricArena, trying to be in Aliu's line in terms of what's going to come up. We see weak signs of improvement, but we are trying to be between 4 billion and 4.4 billion in 2025. We see a surge in international VCs coming up again, increased capital allocation from corporate this time. We are trying to Digital Collective Africa to increase the activities of corporate VCs in the tech ecosystem, pushing also the work with London Stock Exchange on expanding on exit and IPOs. So you'll have access to this graph. We see a bit about what we project this year is going to be. We know how the year has actually started. Yesterday, we have seen what has been the announcement, the level of the US with US sales. So our prediction actually, we'll see how it's going to stand. But without further ado, I'm going to hand over to Nafisa, who will then introduce the big part of the webinar, why we're actually here for the debate around the state of tech in Africa for 2024. Over to you, Nafisa, and thank you so much.
Thank you so much, Dan, for that interesting predictions and also the gender pledge. I would strongly encourage everyone to have a look at the Digital Collective Africa website and see just a bit more about the organizations that are really in the forefront of empowering female entrepreneurs. I think the amazing person that I'm about to introduce to you guys needs no more introduction, because he's known for being one of the biggest ecosystem builders that I know, but also a trailblazer in driving innovation in the tech space. And actually, he was like, I don't need an introduction, but I think Anthony Catt doesn't get enough recognition for the impactful work he does, not only in Africa, but across the world. So thank you so much, Anthony, for making the time, for being here today. I'm going to hand over to Anthony to introduce his amazing panel and also the leaders that are shaping the future of tech in Africa. So over to you, Anthony, and thank you so much again for being here. We are always so blessed to have you a part of our webinars, but just also such a backbone for AfricArena in terms of support. Again, big recognition to the work that you are doing.
Very, very kind. Thank you very much. And thank you for the overview and all the work AfricArena is doing, particularly with this State of Africa report and bringing all that data together. Well, good afternoon, everybody, particularly those who are on the same time zone as me here in South Africa. Thank you for joining this afternoon. We've got about an hour, I would say, to unpack the State of Africa in 2025. But ultimately, we've all read the reports, we've seen the data, the snapshots, and whether it be Briter's report that's coming out next week, Partech's has just come out, Africa the Big Deal, the others. The data points shared, although sometimes vary in final figures, they all tell a similar story. One we know that's been around a significant downturn between 2021 and 2020, well, in comparison 21 and 2022. And that's really been spoken a lot about in the last 2 years, that we've had this downturn, we need to weather the storm. And I guess you kind of look at it from a cause effect perspective and what's going to come next. And the cause, global economic recession combined with systematic challenges in our evolving Africa tech ecosystem, from finding funding fit for founders to what are some of the challenges in enabling funds to scale and founders scale across the continent. The effect, we've had a sharp decline in funding, less exits than anticipated, startup shutdowns, zombie funds, and ultimately the ecosystem support that's needed is probably not evolving as quick enough as what the market needs. And so we've had those conversations, we've seen those panels, we've been at those conferences. The conversation I want to have over the next kind of 50 minutes is what comes next. So we don't need to dive into the data. These fantastic reports like the one AfricArena have done will give you those snapshots, but really ask yourself the questions, what funding vehicles are going to be fit for the business needs over the next decade? What support beyond capital do we need to see to enable founders? And at what stage does the ecosystem become somewhere that is profitable and not just taking international capital and support? We're ultimately building a globally competitive ecosystem. And what do we need to do in the next 5-10 years to get to there? So the questions I'm going to pick today, more of a conversation, are going to be with Zach from Launch Africa Ventures, Eunice from Ajim Capital, David from Briter, and Cynthia from E3 Capital. A phenomenal panel with ecosystem leaders. Most of you know them already in some shape or form, but for those of you who don't know them, this is going to be a fantastic opportunity to get to know them. But we cover everything from fund to research to startup enablers. So I really appreciate you all joining on the call today, and we'll get into it in a second. But also thank you to the 80-90 people that are also on the call today. This might be a panelist of 4 people I'm having a conversation with, but ultimately we want you guys to be involved as well. So you've got the chat function, you've already been introducing yourself, so we know your keyboards work. So if you've got a question, you've got a comment, an observation on what's being said during the panel, please put it in there. I will pick up on things in there, but actually it's an opportunity for you guys to discuss things. And also the AfricArena team, they'll see what you're thinking, what your sentiment and views are as well. And that's going to inform them as they shape this final report going forward. So please do drop things in the chat throughout, particularly if you disagree with us and we maybe need to course correct or steer in another angle. Once again, thanks for my panelists for joining. We're going to make this more conversational than just a back and forth Q&A. So guys, do jump in as and when you see fit. And if you disagree with each other, please do say, we can go down that path if we want to. But the 3 kind of topics I want to try and cover in an hour, if I dare say we can, all these topics are probably more than an hour long in their own right, is firstly, overcoming capital and resource scarcity, which we have in the ecosystem right now. Second one is around how do we create fit for purpose funding models in African tech? Do things need to evolve to service the needs of the startups that are coming through? And then finally, understanding what are the founder needs that will enable the next generation of venture-backed startups to grow and scale beyond just capital. So with those 3 topics in mind, kicking off kind of looking at the overcoming capital and resource scarcity, we know we've seen a decrease in funding in the ecosystem. We've seen some challenges with various program investors having to pull out of the ecosystem or kind of pause funding. So kind of almost a reflection on 2024 and probably by extension 2023, being challenging years to prior years, especially for funding. Zach, I kind of want to come to you and ask kind of, what's your perspective right now on the ecosystem, capital and resource scarcity? Do we need to start consolidating, get more selective to achieve outcomes? Kind of reflecting on what's happened, what are your current views? Kind of kick us off with a bit of an opening statement that we can kind of dive into.
Yeah, thank you, Anthony, and thanks for everyone on this call joining in. Yeah, I think I mean we've obviously had a downturn for the last 2 years, and both the Partech report, the Briter Bridges report that's going to come out soon, the Africa Big Deal report, and the AfricArena State of Tech report. The tone arguably will be slightly negative, but it's more a function of macro versus anything that is specific to the African continent per se. I've said this before, instead of just focusing on what investors want to see, it's important to understand what founders' main problems have been over the last 2 years. So there's always been this question about survival of the fittest. We've had now, for 2 consecutive years, we've had a disproportionate amount of founders in African tech receive the lion's share of funding, even though the dollar amount of funding has dropped. So we've seen fewer deals, but the good deals getting a disproportionate amount of funding. And that's to be expected in any sort of bear market, be it in private equity or venture or any other asset class. I think what's important to note is that equity used to be, I think this may be one of your next questions, so I won't lead too much into it, but equity used to be the catch-all solution, a one-size-fits-all, the first sort of 5 to 7 years of the African VC ecosystem. Like there was no alternative for founders outside of plain equity, right? That we're now seeing a more balanced set of cap tables in companies. A lot of founders, no matter how good their product and tech was, unless they went through an accelerator, had no idea what a cap table should look at. They had no idea how cap tables would look at post-conversion of safe notes. We had different caps and different discounts and different liquidation preferences. You're now seeing a lot of founders that are truly, for the first time, open to sources of capital outside of just equity. And this is, in my opinion, or in Launch Africa's opinion, the start of an age of maturity where founders are very picky about the quality of capital that they raise and the types of capital. If you look at the Indian tech ecosystem about 10 years ago, there was a surge of founders raising capital at whatever terms they could get, right? Because the ball was always in the court of the VCs. Now you're seeing African founders turn down capital if the terms don't make sense to them. I used to see a lot of term sheets where people would ask for 2x liquidation preference or participating preferred versus non-participating preferred, and safe notes with very open-ended conversion terms, etc. You're seeing less and less of that now, and you're looking at African founders saying, what do I need this capital for? Is it for working capital? Is it for expansion? Is it for tech? Is it for product? Is it for marketing? And they're doing a better understanding of asset liability matching, right? So slowly but surely, you're seeing, even though the ecosystem has had a funding winter, you're seeing a shift in the power dynamics where founders are getting picky about who they raise capital from. And that's where you see the opportunity in things like venture debt and mezzanine financing and working capital financing. Coupled with that, you're seeing a lot of the SME financing houses, including, dare I say, the banks in Africa, starting to understand slowly but surely that you can lend to tech startups without necessarily having collateral, physical collateral. So all this plays into this dynamic where capital alone is not the barometer of the success of a venture and by definition an ecosystem, but it's the quality of capital and how that capital is used. And that's something that I would see as a positive in the last year in 2024, even though the dollar amount of funding decreased. I'll sort of leave it at that, but I'm sure there are some follow-up thoughts here.
Yeah, thanks, Zach. And I just want to go in, Cynthia, David, Eunice, is there any immediate points you want to bring in on that? I do have a couple of things I want to dive into at the back of that, but I want to give the space for you guys to kind of kick off your contributions. In that case, oh no, Cynthia, I see you unmute yourself. You go ahead.
Sorry, just going back. I think I had Cynthia and then I lost you for a second. Just come back again.
No, I was just saying, was there anything you wanted to add that? I've got a couple of points I want to unpick from there that Zach said, but is there anything else you'd like to add to that kind of opening statement before we jump in?
No, for now, no. Let's just park the conversation for later. Yeah.
Okay, so
So,
in that case,
so Anthony, and so maybe just one addition. So we were joking before that when Anthony asked us questions, we were all going to look at him blankly, and me and Cynthia seem to have implemented that effectively there. But maybe just because Anthony, you've gone from this really high level view that we just had with Dan, right, and then you've zoomed in very specifically to a couple of specific areas that I think we're going to unpack further. And just one point that I just want to bridge that I think builds a little bit on what Zach has said, is that it may be the wrong thing to think of now as the funding winter and to think of 2021 and 2022 as the norm. That may be something that we just want to start like correcting and shifting in the overall narrative that we have around the Africa VC ecosystem, because I think what we've seen more generally globally is the way that those kind of macro conditions created quite a unique environment for what happened in 2021 and 2022. So just maybe one thing just to think about, Ant, as we're framing this, because if that's the expectation that foreign investors have of what the ecosystem needs to be, or what the baseline needs to be, that might be, that we might not get there as quickly as we're looking to. I think the second thing that I would just also maybe add on to that is, if you look at the last decade of funding, right, VC is very cyclical. So you do have these periods of consolidation as well. And I think a lot of the trends that Zach was maybe reflecting on within the VC space that seem negative or maybe negative in 2024 may actually be the signs of an ecosystem maturing and us getting more clarity around what type of funding instruments work best for what type of sectors, what type of products, and what type of stages. And I think just the third point kind of building on that is if we look at the sectors that were most resilient, say during this change in macro environment over the last 2 to 3 years, and the markets that were most resilient, they were where there was the most diversity in funders and funding instruments. So if you look at climate financing, for example, which has been one of the more resilient, I wouldn't call it a sector because it's a bit of theme that cuts across a number of sectors. A major reason that that has been so resilient is the diversity of funders and the diversity of funding instruments. And I think South Africa as well is also quite a unique country as well because of the depth of its financial sector that has also helped to make it more resilient through the last few years as well. So I would just kind of add on to what Zach was saying, that I think the diversification of capital is not just beneficial for founders, but is beneficial for the ecosystem, for funders, and for everybody, because what we've seen is, right, that diversification has built some level of resilience in other sectors. So I think, that first point is maybe we don't want to say there's funding winter and things are going to come back to the 2021, 2022 levels, or at least have that as the baseline, because I think we might be selling a narrative we need that might not live up to the expectations. I think the second thing is I think VC has actually figured out to some extent where it can work. And there's questions about where it needs to adapt, evolve in, particularly in the climate space. And I think the third thing is I think part of the reason that climate has been so resilient and certain markets and sectors have been is because of the diversification within it. And I think those are those are some of the interesting trends that we've just seen over the last 18 to 24 months that has shown this correction in certain sectors, this resilience in other sectors, which I think is bending all of our minds a bit.
okay, so we're saying as well, when we hear that we're not in a fundraising winter, we don't want to downplay that we've had a bad couple of years, but we're trying to reframe that actually 2021, 2022, Abdul's mentioned here, he agrees with David, because interest rates will never be as low again as they were then, which meant it drove a lot of capital into the ecosystem that we're actually just having to reframe to the kind of what should be the normal. But if we break those 2 points down then, right, there's two sides I'm hearing there. We've got, the funding models that meet the founders' needs, and there may be the deficiency gap in the amount of capital coming in because there aren't the right vehicles to deploy that create the right expectations around what the founders want and what the returns can be. But then we look at the other side, and you kind of mentioned there about some of the key sectors, David, with climate and others, and Zach, you said that there's some outsized deals that take a large portion of the capital up. Let's break those two down, but let's go into the sectorial side first, and maybe Cynthia, Eunice, I can come to you both on this and bring into the conversation a bit more. Fintech, historically, kind of our sectoral leader. Climate, we've seen kind of come on the rise, kind of the highest growing kind of sector, and equally both of them being in the spotlight nonetheless. But we have a lot of other sectors that are significantly underfunded by comparison, whether it be logistics. I mean, AI is a global buzzword, but is AI a big industry for Africa right now? And of course, health is another one as well. So kind of from your perspective, guys, as investors in ecosystem, where are you seeing the focus needing to shift? Are we going to continue to focus on these bigger sectors, or do we need to see a bit more democratization of that capital into other sectors? And if so, kind of how do we bring those sectors up? Is it just more of a focus on them, or do we need to think about different funding models to get them into the kind of the front of the line?
I can pitch in. I just wanted to say something to slightly back what David said, but also slightly disagree with what he said. I think the funding winter is not just an African thing, it's like globally. Like we saw a very drastic decrease in terms of VC funding everywhere, in the US, in Europe, in Africa, and whatsoever. And while everybody is talking about the funding winter, I'm actually overly optimistic on 2025 and like beyond. And I might be biased because I'm based out of the US. And I think with everything happening in the US right now in terms of politics, the new administration coming in, any US investor, whether you're investing in the public market or in the private market, has probably seen a significant shift in the mindset and in terms of deploying capital, or even in the way things have been going. I'll probably say like things has been going really good when you look at the public market. So if things keep that way over the next year and so, I think we're going to see a lot more money go into the ecosystem. So again, highly optimistic for 2025. I might be wrong, but I think we'll definitely see a significant increase in international investors, and hopefully, you know, a lot more of our local investors can get money from LPs in 2025 and beyond. In terms of the sectors, we've definitely seen a huge emphasis on fintechs. I know we were speaking yesterday, we said fintechs in Nigeria has been a bubble for a long time. I think that was needed. I mean, again, fintech is the infrastructure of every ecosystem, but I'm seeing a lot of layers on top of that. Personally, we have started investing in a lot more outside of the fintech industry. We've invested in dev tools, right? The more we build technologies for our ecosystem, the more we realize that it is very expensive to use, you know, outside tools to be able to build. So I'm seeing a lot of developer tools. I'm seeing a lot of B2B SaaS come into place, and I'm seeing a lot of like health tech and logistics and prop tech and all of the things on top of it. I think it is the decision of every investor to decide where they want to put their money. Personally, I'm not a climate tech investor. I think we have at least one or two climate tech investors on the panel. Again, me being very biased, I just think I've had a really hard time understanding why so much money is going into climate tech in Africa. We haven't seen much exit or even like significant you know, markups in those space. So I don't understand why the hype is happening in that sector. But yeah, that's my opinion. I'm going to shut up now.
Yeah, maybe I can just jump in and maybe touching on your last point, Eunice, as to why we're seeing a lot more in climate in Africa. I guess maybe there it's chasing where money is globally, right? If the West is focused on climate and that's the available capital, people wanting to invest in climate, then we are seeing funds creating sub-funds or their next fund being very specific focused, someone who are more sector agnostic, and now they're building now a very climate focused fund. I mean, they're chasing where the money is. And then, you know, fintech offers very good returns vis-a-vis these all other unsung heroes. We have agriculture, health, logistics, etc., which arguably we can't negate the fact that the returns on them are not as high as we'd expect, you know, on other sectors like fintech. So people would shy away from them, which is a factor of the hurdle rate that, you know, is imposed by our LPs. So at the end of the day, it's you go to where, you know, you can return money quickest to your LPs. So I guess at the end of the day, there is a factor there to play in the hurdle rate that we get from our LPs. Maybe it is a conversation that should be had on the table. Should we have reduced hurdle rates for certain sectors to make more funding, channeled into those paths? But arguably, I think even when you look at whether we're coming off a winter or this is now this new normal, I think, there were days when, you had the hyperactive early stage funds, guys would make decisions over a dinner and decide to invest, but acknowledging the nuances in the sector, in the continent at large. DD is taking much longer. People are becoming more picky, not just founders becoming picky with investors. Investors are becoming picky as well with where they're focusing the money at the end of the day, given the challenges that exist. And these particular sectors are not shy of any infrastructure gaps. So again, there's just a lot of money that's needed to overcome the first hurdles that you start when you're building a business before now you can pivot it into a scalable business model. So do we need more patient capital, philanthropy capital? Do we need to see more of this first loss coming into place early stage? Is it coming from the local investors? I think that's where the challenge would come, and then we can now look at these sectors and no one wants to look at just because they won't give as much returns. Yeah.
Okay, I'm listening to this, and it's an interesting question. You mentioned there the point about kind of what are LPs mandating, looking for, and asking, and then maybe is there a disconnect between global LPs and the realities here on the continent? And it's something David and I were asking: is that the biggest driver for where funding's going? Cynthia, you're kind of leaning towards that, but again, we're going back to that same point again around the funding vehicles and the models of funding and where that money's not just the kind of vehicle going in, but the money where it's coming from. And I think, David, back in, was it your keynote at Super Return in 2023, your opening address was VC in Africa's dead, long live VC in Africa, and this whole idea about how do we reimagine, remodel, and repurpose venture in Africa to be more fit for purpose and help guide international investors into understanding the realities of the ecosystem, what's needed. Venture capital, where is it proving effective in Africa? Where does it need to be reimagined? We've obviously talked about over-allocation in certain sectors. I know you've been talking a lot about climate tech and agri-tech with what you're doing with Briter of AgBase, but actually looking at kind of what are the sustainable investment vehicles and models that are fit for those industries. What's your take on the effectiveness of VC models in Africa? What do we need to rethink or reshape, or do we just need to accept that we need different funding types coming into the space more and more and kind of discerning the difference between venture-backed businesses and SMEs and other kind of growth stage companies?
I'm going to set Zach up here because I think is the expert on the topic. I'll defer, but I'll make a couple points that I think just links maybe Cynthia and Eunice's point in as well. Zach, you said this amazing question yesterday on the prep that I've been asking everybody today, which is, if capital is scarce, where can it best be allocated on the continent? And I think, and Eunice, I think that's underlying what you're saying too, in a way. And I think what I realized maybe over the last year and a half is how much the supply of capital dictates where it goes. And so I think for the climate space versus the fintech space, let's just say, so I think maybe the SaaS versus the climate space, is that the supply of capital is shaping where it's going in the climate space. And I think the question for the VC is that the same funders that you'd be able to attract into VC funds, or is this a completely different category of funders? And is this a completely different asset class? And is it just kind of got muddied up into this whole VC space during the kind of 2021, 2022 VC bubble? And I think there's a little bit of the jury still out of that. And I think what Cynthia and the E3 Capital team are doing, which is quite exciting, is they're going, where can VC work in these spaces? They're not saying VC should solve all climate and agriculture. They're saying there's certain product classes that are venture backable, or we can deploy a certain type of funding instruments to unlock. But I think it is a question mark for me that still remains, is what if the VC model can work in climate? And really, how much is there an overlap between the two types of funders? And then I think health and education are those sectors which we often don't speak about. And actually, VCs were playing an incredible role in taking risks on those sectors. And as they've moved away from them, because they are challenging sectors to operate in, no one is stepping in to fill those gaps the same way you've seen in agriculture and climate. it's really remaining grants and foundations. And I think just thinking a little bit around these kind of categories of sectors and thinking about how the type of funders and funding instruments going into them reflect some of the challenges and opportunities, I think is really interesting. On the VC side, and Zach, this is where I'm coming over to you, is that I think we have seen a maturing of the space and understanding SaaS products and fintech products can be venture backable. But I'd be interested to know, does that mean that they're only equity backable? And what is kind of the arsenal of funding instruments that now funds need to think about to help a fintech or help different types of businesses grow along that funding journey? And how do we kind of reorientate us from this supply of capital to the needs of founders?
Yeah. Yeah, and a very, very, very good points. I mean, before I just talk about that, I wanted to just reiterate your point earlier about climate tech. I said something on the prep call yesterday about how, because capital is so scarce in Africa from a tech VC standpoint, I think we may have dropped below the 1% of global capital. I think we were at 1.3 or 1.5 last year. We're now at 1 or just below 1. I have to just keep reminding people that for every dollar that goes into funding an African tech startup, there's unfortunately one less dollar that goes into other founders. It is unfortunately a zero-sum game. It's not that there's a plethora of capital available. And funds have to be have to use a lot of discretion when it comes to where they allocate capital. The reason why climate tech is often misunderstood is because the definition of climate tech is not the same in Africa as it is, for example, in the Nordics or in Western Europe or certainly the US. So unfortunately, most of the LPs in funds in Africa tend to be DFIs, a few CVCs, corporate VCs, but definitely a lot of developmental institutions. Now, their requirements from a climate tech perspective tend to be very first world like. So, for example, how do we reduce the carbon sort of footprint? I mean, I have this one story that I saw in Stockholm 2 years ago where reducing paperwork for immigrants to file job applications was considered a carbon investment because it reduced paperwork. Reducing the amount of proteins in oat milk was considered a carbon climate tech investment. And I was like, oh my God, like this, and this is what LPs will fund, right? Now, unfortunately for us fund managers, accelerators, and venture builders, we need to be respectful of what our LP requirements are, but also remember, to Eunice's point earlier, if there's no DPI, it doesn't care what your mandate is. Ultimately, we are responsible as custodians of that capital to deliver returns. So the reality is climate tech in Africa needs to be viewed differently from what a traditional climate tech investment in the US or Western Europe should be. So I think if we expand that definition to include solving inefficiencies in Africa's food supply chain as a climate tech problem, that's a good start. I mean, there's a company in our portfolio called Price Valley in Nigeria that reduces the time, resources, and effort it takes to deliver basic consumer staples. I'm talking maize, cassava, rice, potatoes, etc., to rural parts of Nigeria. They cannot, for the love of God, get into any climate tech programs because they're not climate tech enough. And I call BS on that, right? Whereas another company that's on paper trading carbon credits with no real utility can get tons of funding. So I think it's incumbent as us as GPs, investment associates, etc., to make the case stronger for what constitutes climate tech in Africa. I mean, I'm not going to talk about climate tech all the time, but it is important to make a distinction here that the providers of capital to funds, aka the LPs, should not lead decision making. They call the LPs for a reason, right? So the cart should not lead the horse, the tail should not wag the dog. And that's what's been happening for a long time. So we need to take back that power and say, this is what founders need. The simple solution to all of this is if we put founders at the core of what we do, then it's easy. LPs should not drive investment theses on the continent. Founders should. and founders should. And GPs are literally custodians of that capital in making informed decisions. That's the overall framework that needs to be addressed here.
So that framework, and actually, Abdul, you've made a good echoing your point in there around how do we kind of stop this copy and pasting VC frameworks, right? We've got 3 VCs on the call here, and by extension, David, who is brings the data and the numbers and the proof points for a lot of venture capital funds and others on the continent. How do we practically address that? If we need more capital in the space, whether it be via VC models or other models, how are you guys approaching those conversations, or what is needed? Where is there a gap that would help you as fund managers? Because this ultimately comes back to the point that more capital in the ecosystem deployed in the right ways, that's not kind of prohibited by outdated or misaligned mandates or agendas, is going to have a better effect on the ecosystem in the next 5 to 10 years. So what is that story, that narrative point we need to have? Or is it simply actually there's not enough proof in the funds on the continent that the LPs are willing to kind of let them take the lead? Where is that gap, and what do you think the solution is? Or what are the things you guys are working on that's kind of getting that over the line, or you think can?
Yeah, fortunately, I think for A3 Capital, we were once the earliest investors in the energy space across the continent. Our first fund came about in 2015, and for energy focus, so we had a lot of learnings when it came to the climate space. So when it came to shaping our second fund, we had a lot more to say than what the LPs could impose on us. Just what Zach has said, I think we are actually a low carbon focused fund, but with very specific columns as to what we look for. We have a portfolio in Morocco addressing, supply chain inefficiencies in the ag sector. We have renewable energy financing in South Africa. Just thinking about it in a different angle, whether it's asset financing here in Kenya. We have been trying to, not just going to what looks like in the West, but addressing what is very specific to us and addressing those inefficiencies. So I guess, fortunate for us, it has been our experience on the ground, allowing us to have the voice on the table. The LPs do not have the biggest Monday, we have a specific LPA that we follow on what we have to invest in, but we're quite vocal on what we will and what we won't invest in. And also, drawing lessons from our first fund, even in climate in itself. We had a huge portfolio that was very asset heavy. I know it's a conversation that is touchy, whether it's asset light, asset heavy, seeing the risk that we took on our earlier days, going into frontier markets. People know now, and now having a struggling time to exit these businesses, given how long it's taken to scale them and the price that people are willing to pay for those. So I guess we have had the opportunity to say, first fund, energy, climate, this is what worked. We saw a lot more opportunity in X, Y, and Z, still within climate, and we want to focus our effort in those instances. So I guess maybe just to answer your question, it has been our experience on the ground that we even leveraged to date, even helping our follow on the companies that we're now investing in, think about how they are building their businesses, what markets they're thinking to expand to, what talent they're bringing on board, just even based on what their vision, the mission is at the end of the day. Yeah, so I guess our learnings have been very helpful to date.
So learnings coming from a kind of a longer standing track record of building on the continent, right? And that's that kind of proof point that you can have. Eunice, you've obviously been in the ecosystem a number of years now, but been launching your own fund as a solo GP in the US. So outside the continent, being that flag waver in North America. What about then from your perspective, coming on the kind of newer side of things, how are you seeing adapting that approach, and how are you telling that story that's bringing that international investor or resource network to the table? Is it more challenging on your side, or are there actually you're finding ways to do that?
Yeah, definitely. I think, again, 90% of my LPs are US-based investors. These are typically family offices, funds of funds, or high net worth individuals. So a lot of the times when they're coming into my fund, I'm not the first VC asset class that they're investing in. So first, they know that they don't, like their LPs, they don't define what we invest in. But second, pretty much like what I typically sell my investors on, and why they get excited investing in the African market is just saying, hey, like Africa is the last frontier. A lot of the times I will go to typically an investor that has invested in, and again, people come at me for this, but I'm going to say it, right? Like I look at proven business models, for example. So a lot of my investors understand that if a company was successful in the US, for example, let's say 40 years ago, and then you see a similar pattern happen in other markets, let's say Europe, in China, in India, or Latin America, it's only a matter of time before that is successful in the African market. And we have seen quite a significant success stories in that path. So it's typically like a very easy conversation to say, hey, it's only a matter of time before these awesome fintechs, health tech, prop tech, logistic, mobility companies, become successful in the African market. So, and again, they understand, like safe investors. I don't invest in climate tech. I personally don't understand, how it works. So like how you make an investment in that sector. Probably because I'm not an expert in the space. And as every investor, you have to be able to understand what are you an expert at? Like, what do you understand? You don't want to invest in a company that you will not be able to help, that you don't know how you're going to exit that investment. And I'm big on exiting. I'm like, how am I going to get my money back when I'm making this investment? Typically something that I like to look from the baseline of that particular investment. But in terms of LPs and where our investors are coming from, I think we're going to see a lot more US LPs. That was already given, but I'm seeing a lot more Middle East and Asia in the last, I would say in the last probably like a year or two. I have seen a significant interest from like Asian, like Singapore, Japan, a little bit in China, Tokyo, LPs interested in the African market. And then in terms of the Middle East, obviously Saudi Arabia, Dubai, Abu Dhabi, I'm seeing a lot more interest from LPs in those markets, like getting outside of the typical US or Europe LPs.
Gotcha. Okay. And I guess the point I'm going to pick up from there, right? You talked about exits rather than liquidity, and that's ultimately the test of the market that is used as a barometer, the outcome that we need to drive. And we've not seen as many of them in as many recent years, and we've probably been dining out on a few from 5-6 years ago that we shouldn't need to be doing anymore. But we've equally seen a number of large companies raising, getting those unicorn valuations and a couple kind of mid-level exits. So let's then jump into my final section, understanding and supporting founders. So what needs they have really beyond capital. And this, I guess I'm going to open this up to you all. And this can be from the perspective of what capacity support do founders need? But equally, you could flip it and say, what does the ecosystem, ESOs and others need to be producing and providing in terms of that support? And whether or not the kind of grant funding that's coming into the space is being used in the right way, that's actually going to enable either infrastructure or these companies to scale and be venture backable, returnable companies that are going to set up the current funds and future funds. And ultimately, like Cynthia was saying, give that track record and proving point that LPs will follow instead of trying to lead. So we get a more fit for purpose capital allocation across the ecosystem. So I'm going to open it up to everybody for this kind of last on the next 10 minutes. Was there any immediate points or observations on that? I know you guys all sit on more on the allocator side, but you're also heavily involved in some of the enabling and supporting functions of the ecosystem as well.
I mean, I can say something really quick. I think typically look at exits from, I think we all look at the billion-dollar valuations, or we look at, the story of Paystack where, they got acquired and everything. But what I have seen from, which doesn't typically make media, is like secondary sales. A lot of the times, and many VCs, African-focused VCs, especially for us that are early-stage investors, have seen a lot of secondary sales. I personally have had 2 last year, and I'm seeing a lot more VCs exiting their positions as their founders are raising subsequent rounds of funding. I think right now in Africa, that's probably like the best exit strategy. Obviously, the next one will be M&As. We haven't seen many of those, but I think we're probably going to see a lot more over the next few years. I don't know about IPO. I don't even want to put my mouth in that, but like that's my opinion when it comes to exit on the continent.
I mean, from my perspective, I'm going to take a slightly different view from the corporate angle here. The one sector in the African economy that has grown despite the drop in VC funding is corporate Africa, and I don't think on these sorts of panels people talk enough about how borderline oligopolistic, if that's even a word, the insurance industry in Africa is, how big the banking industry, and let's not forget the telcos, right? So if you look at profits quarter on quarter and year on year, MTN, Vodacom, Orange, and then you extend it to the insurers, the Sanlams, the Discoveries, the Momentums, they're growing by leaps and bounds, even in downward sort of macroeconomic climates. And there are three reasons for that is African consumer purchasing power is getting higher and higher and higher because of lower cost of data, cheaper smartphones, lower cost of data, and people are just more digitally active, right? I mean, like the average 20-year-old is not going and buying life insurance policies from old men with briefcases. You're buying it through, Naked or Control or similar platforms in Kenya. And so people are increasingly transacting online, and you're benefiting from the fact that Africa is a very young population, right? Now, these corporates cannot, into perpetuity, report these, increasing quarter-on-quarter growth if they don't embrace innovation. And you can either build it or you can buy it. So to both Cynthia's and Eunice's points about ultimately you can create liquidity and returns as funds and angel syndicates and accelerators or whatever, only if you have a liquidity event in year 10 or year 12, which is your corporate trade sale. Now, of course, we have secondary sales between years 5 and year 7, which is where, there's liquidity in the market. But what we should be doing is having more of these discussions with the product managers, the heads of marketing, the heads of ops at large insurers, banks, telcos, and retailers in Africa, and saying, where are you seeing your consumer purchasing and consumer acquisition costs? How are you lowering them? And what startup solutions are you looking to partner with? Because that is the quickest microscope into seeing where your exits will come from. So it's all great with us VCs and angels and fund of funds and the DFIs talking about what sectors we can invest in, but it is almost irrelevant if the corporates aren't part of the solution. So my sort of perspective is, irrespective of how boring or unsexy an industry is, if the corporates love it, that's where you should be putting your money to, because that's where you're going to get your biggest bang on your buck. So and this is education. So one of our jobs, I mean, Anthony mentioned the ESOs and entrepreneurship support organizations. They should be facilitating more direct lines of communication between founders and corporates, because corporates can put out things like RFPs, requests for proposals, what is it called? Vendor management platforms. But these founders have no clue how to apply for these programs. But guess who knows how to apply for these programs? Us VCs, us investors, because we can speak their language, right? So there needs to be more of a dialogue between, how these tech startups will eventually become either acquisition targets of these large corporates, JV partners, licensing partners, and that's how you can create more DPI. LPs are happy, and the entire ecosystem moves up. Just in South Africa, and I'll give you some real examples. There were a few insurtechs, Pineapple, Control, and Naked, that were literally on the periphery of sort of like borderline the extreme left liberal tech community in South Africa. Now all these three insurtechs, their biggest shareholders are the largest insurance companies and media companies in South Africa at significantly higher valuations, right? So we need to be having these discussions with large corporate South Africa, corporate Kenya, corporate Egypt, corporate French-speaking West Africa now, today, because the founders won't do it because they have no clue. And it's not what they do. Founders are there to build cool tech, nice products, and what drives them is utility. They're not driven by corporate POCs, pilots, and partnerships. So it's our responsibility as the ecosystem to bring those two sectors together, to create more liquidity?
I think it's that last that last point, Zach, that you've just said that I think around liquidity with what Eunice was saying as well, right? Which is a key part for the ecosystem going forward is getting that right, both in terms of raising, but also returning. And I quite liked how Eunice was thinking about kind of secondaries, M&A, and like the very hard one to do, which is the IPO. What was interesting, Zach, about what you were just saying, right, is that based on the exit pathways you have in Africa, it determines the solutions that you're going to build. And that is quite a unique that's quite unique to maybe Africa and us if the pathways are through corporates versus through IPOs. And what that might mean for innovation, I think, is quite interesting. I'm going to take one step back, though, because I have no idea where Anthony's going to go with the next questions. We only have a few minutes, and I don't think we've got an opportunity to cover some of these wider points that we're trying to make. So I think the first thing in kind of responding to some of these questions is you can remove 2021 and 2022, and the ecosystem's on a positive trajectory. From 2015 to 2025, you look, Dario makes this point all the time from Briter, everything is bigger than where it was previously. We don't need 2021 and 2022 to sell the African narrative. It's there, it's happening. But I think the other side of it is I come from a financial inclusion background, which is markets don't jump from easiest to reach to hardest to reach. So it's not like all of a sudden we're going to solve fintech and then solve education. And I think this is something we need to appreciate. And I think part of the Cynthia Zach conversation here that's so much fun, and Eunice conversation, is you always need E3 cap. You need the companies that are going to be at the forefront of trying to test new funding models for certain sectors. And we need to learn with Cynthia. And I think that's a really important place that DFIs and sub-commercial funders can play a role. So they can constantly be pushing us into new frontiers to see how we fund innovation. And I think what Eunice, you were saying, and why you're quite optimistic for 2025, I think is because we've seen fintech mature. We've seen it mature quite strongly in the big four. And we have a better sense of the type of products that can be unlocked in the continent. And I think that's going to attract, or is going to be a great selling point as foreign VCs return back to the market. And I think that's what we're picking up in the chat. I think the second bit is we still need to figure out what actually works in climate and agriculture. And we don't have that liquidity. We don't have the returning bit working for that, like we have it somewhat working for fintech and the SaaS side. And then I think there's another set of sectors that's even beyond this, which VC is still struggling to figure out, which is health and education. But there are some signals from fintech that we can see, right? Embedded financing models seem to be something that can unlock innovation within certain sectors. So we're starting to kind of tease and play around with that. And I think what Cynthia and the team have, Anthony, is a great opportunity to push the frontier of that and come back and share what's working. I think kind of what the VCs that are maybe focusing on fintech, focusing maybe where the more mature market is they're the ones that can go sell performance. And I think that's really like the narrative that I want to see start coming out of the ecosystem. I think it would be quite interesting. It's not, is our businesses in Africa venture backable? It's where are they venture backable? And where do I get the returns? It's not an if, but where discussion. So I think that's kind of the first piece that I would say around like how I think we see the ecosystem maturing. I think we're all optimistic for the next 5 to 6 years. If this is how we've weathered the last few years and what has been like a really hard downturn, I think that spells really well for what we're going to see for the next 5 years. And I think as Eunice and Zach and everybody sees, people haven't stopped building. In terms of what I think we need to kind of integrate into the ecosystem in order for us to continue to kind of unlock that next phase is I think we have the instruments. I think we know what works, but even within mature sectors, we don't know where it works. So one of the most interesting things is grants, right? And grants are the instrument that gets the most criticized in Africa. And I think that's a failing of us, not of grants. Grants don't wake up in the morning and say, I want to undermine the VC ecosystem. Like they're neutral, they're technology, just the same way debt and equity is. I think the challenge for us is where do we put grants into the ecosystem so it accelerates sectors through certain inflection points rather than creates barriers for certain inflection points. And I think that's going to be one of the really interesting things for grants is let's use donor and DFI capital to our advantage. Let's figure out where it works and where it accelerates great businesses, not necessarily where it, funds a lot of early stage pre-seed businesses. And I think that'd be a really interesting exploration for donors and DFIs to think about, is how do they reimagine what they can do with their instruments?
Yeah, maybe I can just jump in there on David's first point. I think with one of our portfolio companies, what we're trying to do is they are financing different assets on the ground in healthcare, in climate, in logistics. And sort of what we're trying to get there is sort of a platform where we can go in and see the data. Where is a certain model working? Where is it not working? So again, I think we need to appreciate the role that data will play in making these informed decisions. And then how now do we now come back and now tailor tools that are appreciative to those particular sectors in themselves. I think the other thing that when it comes, to just the non-financial needs that the founders need, I think we've seen this with a couple of venture builders. We've done it through our own TA facility, is sort of providing that talent gap, filling that talent gap within our portfolio companies. So you have, as you know, a partial CFO who can support the different companies, a CTO who can support your portfolio companies, and sort of helping them unlock what they need to do for scale at a certain point in time. I think another model that I've seen really work because at some point the whole challenge is a factor of you're not just aware of what exactly you should do in a certain situation, and this is greatly done by the Endeavor network, where it's a lot of paying forward. How do we make sure that those founders who've done it before others are coming back and teaching what it needs to be done? What challenges did I face when it was financing? How did I turn down some, or how did I argue about different pricing models, valuations? How did I access certain markets? So again, unlocking that network that we do have, and having those people, continuously, pushing those lessons back into the markets will sort of, get our founders into knowing what they need to do to unlock certain aspects. I think there is a role for mentorship and networking that I think we are acknowledging, but there needs to be a lot, just more emphasis put on it. I think the investor network, there's a lot of, business schools, in there you'd find the CTO for your next, for your portfolio company. So again, we need to leverage much more of our networks and provide that support to our portfolio companies. There was, I think, a study last year on, also mental health for our founders. Another aspect that, we just can't greatly overlook. So again, that we also need to create a supportive environment for our founders. They are operating in probably one of the toughest economic times. Pre-2021 is nothing like what we are seeing in the economic times for today. So a lot of support needs to go to these founders, and the nuances and the challenges that they are facing cannot be ignored. I think back to you, Anthony.
Back to me with 2 minutes to spare. Okay, we've covered a lot of ground in this conversation, touching upon a lot of probably some of the key points that the report's going to cover, and hopefully for the team, this has given them some more insights. And thank you to everybody that's also contributed in the chat. I've seen some really great points that either back up what's being said here or kind of additional items we could have gone into. I think my kind of reflection for 2025 is we've come out of this perceived downturn, and we've kind of mentioned here that the new normal is just actually the reality of the ecosystem that's been steadily growing. And if we remove those couple of years of kind of high capital, we probably get a bit of state of kind of normal reflection. But actually, that 2025 is a bit of a recalibration. We know that the African ecosystem is not a reflective mirror of other emerging markets, and we need to rethink the capital stack, both in terms of type of vehicle using to deploy capital, but also kind of aligning and managing that expectation from international investors so that they're not leading us down the kind of wrong pathways. But that's on us as an ecosystem to build those track records and create those narratives. I think really interesting that last part there that we've kind of touched upon around, corporates and non-sector stuff, engaging with them, but equally looking at kind of the various other different exit vehicles with M&A, CVC, and everything in between. They are some of the normalities you see in matured markets and ecosystems. We see those enablers and connectors in the ESO space who bring those people together. And ultimately, we need that support function to be building better bridges into those kind of commercial and kind of exit opportunities as well. And then finally, I think the piece there is kind of seasoned founders that have been there and done the ecosystem? How do we promote and champion them, bring them together to start teaching that next generation of founders, not just from us, from the ESO side or the investor side as well? And so hopefully for 2025, what we're going to see is a bit more open dialogue and conversation across the ecosystem around these things. Of course, we'll digest the reports and data in the coming weeks, and we'll get back onto the kind of event circuit where we'll be starting to have more of these conversations. But if there's one thing to take away from today is there seems to be alignment around what these challenges and opportunities are, and that we just need to build better narratives around them to engage the right resources and allocators that can come into the ecosystem and grow it. So on that bombshell, I'd like to thank again my panelists, Cynthia, Eunice, David, Zach, for joining your contributions both today, but more broadly, what you're doing with ecosystem is fantastic. And of course, as well to AfricArena, the whole team on the call, but the broader team across the continent for the work you're doing and have been doing for a long time in the space. And we're all very excited to hear you announce your global tour dates for your events and activities in the coming weeks and months, and of course we'll all be participating and attending. But for now, just want to say thank you all once again for joining us, and look forward to seeing you in the next conversation. But before I do, AfricArena team, is there anything else to say, or can I kind of close the proverbial curtains?
No, it's over to me, Anthony.
Back over to you then.
It's like I'm ready to end the webinar. I just want to reiterate again, thank you so much to the speakers and the panelists. You guys were incredible. A huge thank you to Anthony for moderating that session. It's always really important for AfricArena to kind of get a bit of insights on one, the data that's being put out in the tech ecosystem, but also what the future of the ecosystem looks like. A big thank you to the incredible attendees that have joined the webinar. Thank you for keeping the chat interesting with all those incredible questions. I would like to encourage you to keep asking those questions. Feel free to send us an email. Feel free to say, hey, Naf, can you plug me with Anthony? I want to reach out to him. But also feel free to add him on LinkedIn or add any of our incredible panelists on LinkedIn. Our call for action for you is to just keep connecting with each other, keep the conversations, keep breaking boundaries and barriers and making it a better place. We've also now put out the QR code for you to scan and download the State of Tech in Africa report. We're very excited about this, but also a huge shout out to the team that's put in very long, nice, and incredible work to get this report done on time. Just really thank you so much for your dedication. And then to answer Anthony's question, we're going to give you guys some save the date. So Dan, do you want to just quickly jump to the save the date slide for me? We can come back. So for those on the call and those based in South Africa or anywhere in the world, if you feel like flying down, we have our State of Tech for 2025, our actual physical event happening at the AWS HQ in Observatory on the 20th of Feb from around 4 p.m. We would love for you to join us. We also will be sending this information on all social media platforms, as well as a invitation. Some other dates that you can save already is the AfricArena Grand Summit for 2025, which is taking place at CTICC, we hope. And it's the 2nd and the 3rd of December, if I remember all of this off my brain. And then we also have the VCON conference that is happening the 28th to the 30th of November in Cape Town, and you don't want to miss that. As Anthony mentioned, we are going to be launching our circuit this year. AfricArena changed its approach, and we put out a proposal and we asked, where would you like AfricArena to go this year, and where would you like to host us? So we're working through that, and we will launch our circuit and save the dates very soon so we can see everyone on this webinar physically. Join us for one of our incredible summits. Again, please do scan the QR code and download the report. We will also then send it in an email, just thanking everyone for joining us today again. And then to the AfricArena team, before I close out, is there anything else, Dan, that I'm missing from your side? No, we're good.
No, nothing on my side. It was really a pleasure to have you all. And yeah, for those in Cape Town, please join us on the 20th of February. And yeah, be on the lookout on social media. We start announcing step by step our circuit. And then, yeah, let's keep rock and roll.
Amazing. Thank you so much again to our incredible panelists, AfricArena team. Thank you for being incredible. Our CEO, Christoph, thank you for your incredible support. And last but not least, our attendees, thanks so much for being here and making the time. We look forward to seeing all of you again at our next State of Tech event, as we mentioned, on the 20th of February. But other than that, have a lovely wacky Wednesday. Enjoy your drinks, stay safe, stay healthy, and keep smiling. Thanks again, everyone. Bye.
Thanks, everybody. Cheers. Bye.
Bye, everybody.